Reporting damage, it is soft rock shit. The TSP rock school, the overgrown super shit. The supermodels, all they can get enough of it. The overgrown super shit against the GTX, it is rugged GT.
Hey everybody, welcome to the Lund Daily Update for Thursday, July 23rd, 2026. 2 months until fall. My favorite season of the year. All right, let's get today's crazy market in the rearview mirror, shall we? Well, we opened with a big gap down today. Remember how during this phase right here, I thought maybe we saw a different change in character this day, and then it kind of got weaker yesterday? Well, today we had some horrific reactions from namely Google and Tesla, which we'll take a look at in just a second. Market opens gap down. Initially looks like it's going to rally a little bit, and then it just gets trapped below the 9 for almost 2 hours, which means a lot of selling. However, we did flip the moving averages here, and a lot of people, I think, thought, okay, possibly V-shaped recovery, but then we just rolled back over. A little bit of tape painting here at the end of the day, I think. Right near the lows. I don't buy it so much. We are getting somewhat of a pop, I think, on the Intel. I think Intel is, let's take a look here at Intel. Yeah, so Intel's holding the market up a little bit, not holding it up, buoying it a little bit. But I want to talk a little bit more about what happened, why it happened, and also I want to talk about the best indicator there is out there. So this is Google, which was down, I think, 7%, right down at the 200-day moving average. The big loser was Tesla today, down 14%, breaking through support levels, just ugly, ugly day. And so, look, there's always a lot of factors involved in the market rolling over or in a stock rolling over, but here's the big one. The big one is we are in a CapEx war. Okay, the big hyperscalers, the big cap tech names, they are in a CapEx war. Every quarter, they're talking about increasing CapEx. And the more they increase their CapEx, the less profitable they are. This is even the case with Tesla. Tesla is more related to Optimus. When's that going to, make a meaningful impact? But they got this big terafab plant that they're building, right? That's CapEx. So the problem that these companies have, it's interesting. I'm going to draw an analogy to what happened in the 90s with Amazon. Amazon was negative in terms of earnings quarter after quarter, year after year. And Amazon bulls would say, just wait. They're doing big CapEx spends. They're building out infrastructure. And at some point, they're going to have all the infrastructure built, and then they're going to flip the switch and be profitable, and their stock's going to go to the moon. The difference between what was happening with Amazon then and what's happening with the big cap tech companies now is this was a discretionary move by Amazon. Jeff Bezos saw the future he wanted to create. So he took the option to increase CapEx. No one else was chasing after that future. In fact, everyone was like, what are you talking about? You're crazy. So that was a discretionary spend in CapEx. The big cap tech names now, they don't have discretion. They have to be spending this money because if they don't, they're going to get left behind. So there is this arms race in CapEx that's different than a discretionary spend. At some point, they'll be satiated. There'll be enough AI infrastructure built out. There'll be enough energy centers, whatever they're building out. And once that happens, they'll cut back on CapEx. You'll see all these names pop. But when will that happen? 1 quarter, 2 quarters? 2 years, 5 years, we don't know. And that's the problem that these big names face right now. So that's an overhang in the market for sure. But I want to talk about something a little more macro. I want to talk about what I think may be the best indicator. Let's flip back over here. Okay, so, hey, let's flip back here for a second. Everyone knows technical indicators, technical studies. And everyone's got their favorite indicator. Everyone's got the one they swear by. I tend to think most of them are overblown. All indicators are some derivation of volume and price. Volume seems to be less important in the last few years than it's been. So really it's price that's important. Some of them have a time component. But whatever your indicator is, sometimes proprietary indicators are better. I'll give you an example of two. I went last week to meet one of my longtime friends who's a Lund Loop subscriber. You'll know him in the trading room as Velo Trader. So we went, had a couple beers over at Fashion Island, Newport Beach, trading old stories, talking about markets. And he's a very analytical trader, right? He likes to have spreadsheets and know where all of his positions are and really drills down on that. And that's great. That's his style. Me, I don't. I know what's going on in my long-term positions in my head, my short-term position. I don't really write them down a lot. And what I told him is I said, here's a great indicator. When I sit there on a weekend and I go, you know what? I should really map out all my positions. I should really figure out the exact allocations I have and where they are in my long-term and short-term. Whenever I do that, that is a sure sign that the market is at a tipping point. Now that's a Brian indicator. I can't scale that and help you out with that. But here's another indicator that you can take advantage of. One of the things that has become apparent in the last few years at the Lund Loop is how the watch list that we have become indicators in themselves. So just for reference, if you're a free subscriber, here's how it works. I've got a focus list of stocks that I am monitoring that are always being surfaced based upon price and chart action. Once they get into the spot where I think they're ready to trigger, I move them over to what we call the daily setups list or the green list. These are the names that I think have the best chance to move the most in the next 1 to 3 days. Now, when these trigger, they trigger one of two ways. Either they fail and they fall off the list, which means they never get into a spot where you'd buy them, or they actually trigger on the upside where you would buy them, and they graduate over here to what I call the active sequence. These are names that have gone from the green list to the orange list, the active list, and we're going to monitor these to see if they can turn into swing trades. So you go from the 1 to 3 days to now potential 1 to 3 week swing trades. I also just recently added this other list called the considerations list. These are names that I think on a momentum basis might fall through, even though they're not technically set up on a daily. I usually like to key the daily setups off of 1 or 2 bars. Okay, so these watch lists will ebb and flow as the market is in a risk on or risk off mode. Usually when there's too many on the list, that means there's going to be a big move one way or the other. When there's too few or 0, it means there's going to be a big move. When it's somewhere between, I would say 6 to 12 names, that's the sweet spot, right? As we're constantly seeing things go back and forth between the daily setups and the active list. Well, yesterday, as you saw here, if you were paying attention, we had 2 stocks. That was it. 2 stocks on our list. They were both on the daily setups list. One's Netflix, and that's here based upon that gap down on earnings, this big stick here, and then this sideways base. This gives you a very narrow spot to get long if the stock breaks, because it's very easy to define your risk and know where you're wrong. The only other one on the list was Apple, right? Apple had made this nice move here. It pulled back, and it had this very tight inside bar. Apple gapped down today, so there was nothing to do. Netflix didn't break above here, so there was nothing to do. But that's it. Just 2 names. And what I said yesterday is I said, when we have very few names or a lot of names on our list, that almost always means a big move is happening. And well, that's exactly what happened. We had a very big move in the market today, which is actually disguised a little bit by that tape painting at the end of the day. But let's go through and see exactly where we're at, because I think we are on the precipice of a very, very important spot here.